Welcome to this explainer. If you're a focused learner looking to cut through the legal jargon and truly grasp how wealth is taxed at the end of life in South Africa, well, you're in the exact right place. Today, we're going to completely demystify the South African Estate Duty Act 45 of 1955. Now, I know that sounds incredibly intimidating, but as we go through this, you're going to see that the underlying mechanics are actually surprisingly logical.
So let's dive right in. I want you to picture the entire tax calculation not as some messy, overwhelming pile of paperwork, but instead, think of it as a giant funnel. We start at the very top, pouring in absolutely everything a person owns. Then, as gravity pulls everything downward through that funnel, we systematically strip away different layers. Things like debts, allowable legal deductions, and a really generous tax-free safety buffer. Whatever manages to survive and make it all the way to the bottom of that funnel, well, that is what actually gets hit with the final flat tax owed to the South African Revenue Service, or SARS.
To keep things organized, here's our roadmap. We'll start with the estate duty funnel concept, then hit Step 1, the gross estate. Next is Step 2, allowable deductions, followed by Step 3, the primary abatement, and Step 4, estate duty rates. And finally, we'll wrap it all up with a practical calculation example.
Okay, Section 1, the estate duty funnel and navigating the law.
First off, what are we really talking about here? At its core, estate duty is simply a wealth tax. It's levied on the total value of a deceased person's estate, governed strictly by the Estate Duty Act 45 of 1955. This isn't just some arbitrary number a tax collector makes up on the spot. It's a highly structured legal framework that executors absolutely must follow. Really, it's best to think of it as a rigorous final audit of a lifetime's balance sheet. Moving on to Step 1, the gross estate. This is where we start at the top of the funnel.
So, what's Step 1 on the executor's checklist? It's calculating the gross estate. This encompasses absolutely everything owned at the exact date of death. We haven't subtracted a single cent yet. Right now, we're just gathering the total universe of the deceased person's wealth.
But here is where a lot of people actually get tripped up. The gross estate isn't just tangible stuff. Real estate, bank accounts, vehicles, shares, personal belongings. You also have to combine that with what the law calls deemed property. Deemed property includes things that weren't physically sitting in their bank account, but are legally counted as part of their estate for tax purposes anyway. The most common example? Domestic life insurance policies that are payable to third parties. Yep, unless very strict statutory exclusions apply, those massive life insurance payouts are poured straight into the top of our tax funnel. Surprise! SARS knows all about those too.
All right, Step 2, allowable deductions. Let's start narrowing down that funnel.
Once we have that massive gross estate number, we don't just tax it, thankfully. Under Section 4 of the Act, executors are legally allowed to pull specific liabilities and expenses right out of the funnel. This is where things start to shrink down. Before SARS takes a cut, you get to subtract quite a bit. You deduct all debts owed at the date of death, so outstanding bonds, credit card debt, even unpaid income taxes. Then you subtract the practical, everyday costs of passing away. Funeral, tombstone, and burial expenses, those are all legally deductible. Finally, you subtract administration costs. We're talking executor's fees, master's fees, and those often hefty property transfer costs. All of these safely escape the bottom of the funnel. Now, listen to this one, because it is an absolute game changer in South African tax law. The Section 4Q deduction, commonly known as the spousal exemption. It dictates that any property or cash left to a surviving spouse is completely 100% exempt from estate duty. If you leave your entire multi-million rand estate to your husband or wife, it literally gets pulled completely out of the funnel. No estate duty is triggered at that moment. It's an incredibly powerful estate planning tool that effectively hits the pause button on the taxman.
Next is Step 3, the primary abatement. This is our tax-free buffer. Okay, so we've got our net estate after taking away those legal deductions. But before SARS touches a single cent of it, every single estate gets a massive tax-free buffer known as the Section 4A primary abatement.
And here's the magic number. The baseline tax-free abatement in South Africa is a staggering 3.5 million rand. You just subtract this right out of the net estate. If your estate value drops to zero, or even goes into the negative after subtracting this 3.5 million, the funnel closes. You owe absolutely nothing in estate duty. For the vast majority of South Africans, the single rule means estate duty will never even be on the radar.
And it gets even better with something brilliantly known as the rollover rule.
Remember that spousal exemption we talked about a minute ago? Well, let's say a spouse passes away and leaves everything to their surviving partner. That transfer is totally tax exempt. Because they didn't need to use their 3.5 million rand abatement, it doesn't just disappear into thin air. It rolls over. When that second spouse eventually passes away, their estate inherits that unused portion. So the second spouse's estate is legally entitled to a combined tax-free buffer of up to 7 million rand. Pretty amazing, right?
Finally, step 4, estate duty rates. We have reached the bottom of the funnel.
Now, if there is actually a positive financial balance still sitting in the funnel after subtracting the deductions and that massive 3.5 or 7 million rand buffer, we reach the bottom. This leftover amount has a specific legal name, the dutiable estate, and it is subject to a very straightforward two-tiered flat tax rate.
Here's how it breaks down. The dutiable estate is taxed at a flat 20% on the first 30 million rand. It's only when the dutiable estate, again that's the wealth left over after absolutely all deductions and abatements, exceeds 30 million rand that the second tier kicks in. Any wealth over that 30 million threshold gets taxed at a slightly higher 25% rate. It's essentially a progressive nod to taxing extreme generational wealth.
Let's wrap up with a practical calculation example, just putting it all together.
I know we've covered a lot of theory and legal definitions. Let's pull this abstract math out of the clouds and run a real scenario through our funnel to see exactly how it works. Imagine someone passes away, leaving behind a house and some investments worth a total of 6 million rand. They leave everything to their adult children, which means, crucially, the spousal exemption does not apply here. Now, at the time of their death, their outstanding debts, the bond, and funeral costs total 500,000 rand. Let's run this through our 4 steps. Starting at the top. Step 1, we take the 6 million rand gross estate. Step 2, we subtract the 500,000 rand in allowable Section 4 deductions. That leaves us with a net estate of 5.5 million rand. Then, step 3, we deduct the Section 4A primary abatement. We subtract that standard 3.5 million tax-free buffer. Do the math, and the amount remaining in the funnel, our dutiable estate, is exactly 2 million rand.
Which brings us to step 4. We apply the 20% tax rate to that 2 million rand dutiable balance. 20% of 2 million leaves us with a final estate duty payable to SARS of 400,000 rand. And here's the catch. The executor has to pay this $400,000 directly out of the estate's cash reserves before they are legally allowed to distribute anything to those adult children. It's a very strict prerequisite, which makes ensuring estate liquidity absolutely vital.
So that is the complete architecture of the Estate Duty Act 45 of 1955. The whole shebang. From the gross estate, down through the deductions and abatements, all the way to the final flat tax. Now that you intimately understand the mechanics of this wealth tax, it begs a really important, quite personal question. If your life's assets were poured into this exact funnel today, what would come out the other end? Thank you so much for joining me in this explainer. Keep learning, and I'll catch you in the next one.